This is Unsiloed, brought to you by Alumni FM, connecting people through stories.
Welcome to Unsiloed. This is Greg La Blanc, and I'm here with Terry Odean, who is professor at UC Berkeley Haas School of Business, and he is an expert in the area of behavioral finance. And although he hasn't written a book yet, in spite of the fact that people like me are pestering him to write a book, he's written a whole slew of articles, some of which are very technical and some of which are, super readable. I think the latest article, which I really enjoyed, was the super latest one is on Robinhood. But you've got this really nice survey about individual investor behavior, which I really liked, which is available up on your website, and I'll throw that up on the site for the podcast. So welcome, Terry.
Thanks. Glad to be here.
So you study individual investor behavior, and historically in the area of behavioral finance, right? There's been a lot of studies around professional investors, or even before behavioral finance. So if you think, go all the way back to Jensen's studies in the 60s and 70s, right? He was trying to figure out, is there any way to beat the market? And so he was looking at mutual funds, and he came to the conclusion that these active investors, mutual fund investors, generally lag the market, both pre and post fees. And so that was sort of the origins, really, of the indexing business, right? Were these studies, and every single finance professor that you meet on the planet will tell you to invest in the index, but they didn't really give a whole lot of attention to individual investor behavior, kind of small retail investor behavior. In part, I think, because the data was kind of hard to come by. And you were really the first to turn a lens onto kind of individual investors to figure out what makes them tick, how do they perform, and so forth. What kind of drew you to that? And we'll talk a little bit about your unusual kind of interdisciplinary background and unusual educational path in a bit. But what kind of drew you to study individual investors?
All right. Well, we can, as you say, talk about how I ended up in a PhD program in finance. But I started the program in finance with the intention of doing behavioral finance, trying to apply. I had studied with Danny Kahneman as an undergraduate at UC Berkeley, and I wanted to apply the type of research he had done with Amos Tversky to finance. Basically, it's basically acknowledging that people are not hyper-rational when it comes to making decisions, even when it comes to money. So I looked at individuals. Actually, it wasn't that I was primarily interested in individuals. Rather that I thought, well, if there is going to be a group for whom these biases are not likely to have been corrected from experience and learning, it'll be individual investors. I thought institutional investors, certainly most of them are human. They have human biases. However, they've had more opportunity to learn. And I didn't know how much learning had or hadn't taken place, but I thought, well, individuals are far less likely to have had the opportunity to learn that they are behaving suboptimally, that their biases are causing them to make mistakes. The other reason that I wanted to look at individual investors is because I wanted to initially avoid conflating behavioral biases and agency issues. Mm-hmm. And what I mean by that is that individual investors, especially at a discount brokerage firm, and I got my initial data sets from a discount brokerage firm, are making decisions for themselves. At the time, this firm did not provide financial advisors and advice. That's changed, but when I got my data set, the individuals made their own decisions. So it was relatively straightforward to say, this is a person making a financial decision that is going to directly affect his or her wealth. It's a principal, what we call principal making a decision for a principal. Unlike what it's sometimes referred to as a principal-agent relationship. You might have a financial advisor recommending something to an individual, but the advisor might be influenced by some of his or her own either professional or financial concerns. The advisor might say, well, I think this particular fund, while not really better than that fund, pays me a higher commission. That certainly has influenced more than one piece of financial advice. And it gets even more complex for institutional investors. So if you see a money manager making a certain decision, then you have to think, well, the money manager is in a position where usually he or she is trying to get ahead, increase his or her compensation, which if the money manager is in a typical situation means increasing the number of people who come into that fund, the sort of assets under management. The money manager may be trying to get promoted to a bigger fund, which means impressing the people higher in the firm. The firm is an agent acting for the clients. The clients could be institutional. The clients could be retail investors at a mutual fund. It all gets very complicated. And so if you see, for example, one of the first things I looked at was excessive trading. The very first paper I wrote as part of my dissertation was a theoretical paper. It's just pure theory, and it took existing models of how traders, people in financial markets, make decisions in an environment where there's information, noisy information. And the change I made to these models was, instead of assuming that the economic agents always know exactly how good their information is, I assumed that these agents were overconfident in the sense that they thought their information was better on average than it actually was, which would be analogous to thinking they were better at analyzing information than they actually were. So I took a couple of existing models, plugged in this single assumption that people thought their information was better than it was, and a bunch of stuff came out of it. You see that people trade more when they think they know more than they do. They tend to earn less. They tend to diversify less. So their expected utility goes down or their earnings go down. So when I got data from a discount brokerage firm, one of the first papers that I wrote tested to see whether people were trading more than they should. Now, I didn't know of a book where you could look up how much should a person be trading. However, there's a fair amount of reason to suspect that a lot of the trading that was going on was speculative. It wasn't being made for sort of fundamental reasons, like I'm buying stock now because I'm young and I'm saving, or I'm selling stock now because I'm older and I'm now starting to spend some of my savings, or I'm rebalancing my portfolio. So in fact, one thing I looked at that really surprised me is I looked at trading activity on the New York Stock Exchange going back to 1900 up to when I was writing the paper, which is in the early 90s. And early to mid 90s, I guess, mid 90s. And turnover on the stock exchange was the highest at the beginning of the century, which surprised me. It was extremely high. And it stayed up and down, but pretty high up until the Depression. Then it went down a lot. It bottomed out during World War II, when obviously a lot of the people who would have been trading were elsewhere. They were, overseas fighting, and the people who were home seemed to have other things to occupy their attention. So turnover dropped below 10% in, I think it was 1943. And then during the 50s and 60s, it hovered in the 15, 20% range. Then it started to go up, and by into the 90s, in fact, by the late 90s, turnover was back up at 100% or so. And I thought, well, the need to rebalance, the need to take money out because you have to pay your daughter's tuition, the need to put money in because you're saving every month, that shouldn't change by a factor of 5 or 6 over a couple of dozen years. But the desire to speculate, that probably does change. So in any case, I looked at the data, and I found that these individuals were trading too much. And they were trading too much in one simple sense. I said to myself, okay, I don't know just how much people should be trading, but on average, when you're trading, if you're trading for a speculative reason, if you're trading to improve performance, you would like the stocks you purchased to go on to outperform the stocks you sold by enough to cover your transactions costs. If you're not hitting that benchmark on average, you should probably be doing what many financial advisors have suggested, which is just buy and hold. What I found, and this surprised me, it's actually the only real surprise I've gotten when doing empirical work, which is that the stocks these investors were buying were on average underperforming the ones they had just sold, even before subtracting out transactions costs. So they were trading too much. Now, to get back to the original question, why look at individuals? Well, if I had found that institutional investors were trading too much, people would have said, well, that's an agency issue. In fact, there was already a theoretical paper that had said, if there are money managers who have skill, and there are money managers who don't have skill, and the money managers with skill trade routinely to take advantage of their information and their skill, then the other money managers who know they shouldn't be doing anything because they don't know anything are going to trade so that clients can't just look at the trading and say, oh, this person has skill and this one doesn't. So that was a reason to look at individuals. The other reason to look at individuals is, as you point out, they had been basically ignored. When I started taking classes in finance, one of the things I realized is everything I'm learning here is going to be useful for a professional in finance. I'm learning about, I took corporate finance. I learned about, corporate taxes, about structure, about how much a company should be leveraged. I took investments. Investments was really, oriented towards running a large portfolio, trying to assess performance. A lot of work had been done on assessing performance. By the way, Jensen's early work that said that professional managers underperform, that's somewhat controversial if you ignore fees. I don't think there are many studies that show that institutional investors outperform as a group after subtracting out fees, but there are some that show that they may do well before fees. In fact, I've written a paper, not U.S. data, but I wrote a paper with some colleagues where we looked at every single trader in Taiwan, and we compared the performance of individual investors as a group to institutional investors as a group. And at that time in Taiwan, the institutional investors were definitely beating the market as a group. Whether they passed that outperformance on to their clients after charging their clients fees is another question. So the work in finance, the big explosion in finance when I was a PhD student was around things like derivatives pricing, taking the Black-Scholes model and the binomial pricing model and starting to extend them to a wide range of products, basically financial engineering, using these tools to create new financial products. And that's all fine and good, but it wasn't doing much for individuals. And at the time I thought, maybe finance should do something for individual investors, for what we might call more ordinary people.
Well, now that we know more about individuals, it's not clear whether this is benefiting the individuals more than it's benefiting the people who can exploit those individuals. I think your research has suggested all sorts of ways that institutions can exploit the propensities of individuals. No?
Absolutely. So when I've taught behavioral finance, as I know you teach, I used to teach it, and I would say in one of the first classes, I say, we're going to learn things here about people's behavior in financial markets and financial settings. And you may choose to take what you learn here and improve your own decision making. You may choose to take what you learn here and go on to create products or policies, products or policies that improve outcomes for households, for individual investors. Or you might take what you learn here and use it to take advantage of
create Robin Hood. We'll get to that, but
I didn't say that. I'm not the one who said that so far.
But
yeah, I mean that's the same in marketing, isn't it, Greg? I mean, what you learn in marketing, almost, there's a lot of knowledge in this world that can be used for a lot of different purposes, to help people or to help yourself. And if you're clever, you can come up with something to do in your life that helps others and helps yourself. But that's a constraint.
Well, we can circle back to that, but I think if we go back to this idea of behavioral finance, kind of in the early days, right? You said you studied under Danny Kahneman, and we also heard from Don Moore. I talked to him a couple of weeks ago, and it's easy to understand how things like overconfidence can hurt people in their ordinary life, right? You're carrying a knife around, or you're riding your bicycle down a cliff or something like that. But the financial markets were supposed to be the one place where, you can't really fall on your knife because the markets are efficient. And so no matter how misguided you are and no matter how stupid you are, you can't impact the prices. At least that was the idea. So if, maybe with transaction
costs. Wasn't my
idea,
by the way.
Oh yeah, but this was sort of the framework that early behavioral finance people had to work with. And so although yes, you may wind up trading too much in a world with transaction costs, or maybe you'll be under diversified because you fail to understand modern portfolio theory. But the finding that you would systematically be making the wrong trades because the markets weren't priced in a way that would reflect perfect market efficiency, that I think is pretty important, and it says something about the markets. Is this when the early behavioral finance folks started to make these points? How did this impact the way in which we view markets generally? And the respect that we have for efficiency. I mean, has the mainstream view of efficient markets been impacted, or is behavioral finance still kind of a fringe discipline in your view?
Well, I'm not sure those are necessarily the either or. So, efficient markets, a strong belief in efficient markets, or a strong belief in strong market efficiency, was, in my opinion, more of a faith than a science. And once smart people have a faith, they do a pretty good job of defending it. That I think the issue is markets vary in efficiency, and it's also not necessarily the case that you can easily make money just because you recognize that a market is inefficient. I think in terms of weakening the faith in market efficiency, that I I don't think behavioral finance chipped away at it. In fact, one might say prior to behavioral finance, in the sense of really getting down to the psychology of decision making and how that affects investor behavior, there were several papers in the 80s that were literature sometimes referred to as the anomaly literature. These were papers that showed anomalies in financial markets, things that were inconsistent with efficient markets. So that chipped away at belief in market efficiency. Another thing, that behavioral finance probably chipped away a little bit because it would then say, well, maybe why we have these anomalies is because people make decisions the way psychologists say they make them, not the way a few very mathematically oriented economists thought people should make decisions. I think, though, that the big blow to the faith in efficient markets came from markets themselves. You're old enough to have been around in 1999 when the stocks, especially internet stocks, just shot through the roof, and NASDAQ just went soaring, and then in March of 2000 went tumbling down. And there were a few people who did some backflips trying to explain how that was consistent with efficient markets. But I think most of us looked at it and agreed that this had a little bit to do with irrational exuberance, that people had gotten too excited, that people had projected that stocks that had been going up would keep going up, that people had got drawn into the market who hadn't previously actively participated, that people started to borrow more and more in margin, which allowed them to buy more and more with less and less money, and that drove a lot of stocks up high. And one of the things that backs up that view is in 1999, I remember reading some interviews with mutual fund managers who stated on the side, I think these high-tech stocks are overvalued, but if I pull out of them, my clients are going to leave me. There were examples of that. So back in summer of 1998, if you look at two funds, George Soros's fund, which was run by Stanley Druckenmiller, and the Tiger, I think it was the Tiger Fund,
Julian
Robinson's, Julian Robertson's fund. They were both, Julian Robertson had, Soros's fund always had a little bit more in high-tech stocks, but they were down in the 10 to 15, maybe 20% range. And then the fall of 98, at the end of the summer, Julian Robertson said, these stocks are overvalued. I'm getting out. And Soros upped the ante. Maybe this was the summer, I'm sorry, it might have been the summer of 99. But this is what happened. That basically Soros's fund, Druckenmiller, doubled down and bought more and more. And then the ones, and then the stocks that he already owned that were high tech went up in value. And so eventually his portfolio was up to almost 60% high tech stocks, and Robinson's was down to virtually zero. And what happened at these two funds? Bear in mind, these are two really smart, really successful guys controlling a lot of money with nearly total discretion. They can invest in what they want to invest in. These are the informed investors of the, of the efficient market story. When people tell a story about how the individuals don't matter because they all wash out and it's only the people with information that matter, these are two of those people. And they're placing opposite bets. And what happens in terms of, again, this agency issue? Well, the Tiger Fund was losing clients over and over and over again. Robinson tried to basically freeze clients out so that they couldn't withdraw more money. And finally, in March of 2000, he closed his fund. Meanwhile, in November and December of 1999, early January, money was pouring into Soros's fund. I think it was like $250 million. New money came in November of 1999. And then in March, which was when Julian Robertson closed down his fund, NASDAQ and the high-tech stocks started to trade. About a month later, in April 2000, Stanley Druckenmiller was interviewed by Floyd Norris in the New York Times. And he basically said, we knew these stocks were overpriced. We thought it was the 8th inning, and it turns out it was the 9th. Mm-hmm. They basically thought they could ride the wave a little bit longer before it would crash on them. So that was a belief in inefficiency.
Well,
that was basically saying...
Julian Robertson thought it was the 9th when it was really the 7th.
Yeah, that's right. They both got it wrong. They both got it wrong. And Julian Robertson was right when he said these stocks are overvalued by any sort of fundamental analysis, or maybe not any, but by the usual measures of fundamental analysis. But that didn't mean that the market wasn't going to keep going on. Was it Keynes that said the market could remain irrational longer than you can remain solvent? And that's basically what happened. I mean, Julian Robertson's still solvent, but the irrational tide pushed against him and knocked him out. Yeah. So one got out too early, one stayed in too long.
Well, the key is I think they both probably agreed on fundamentals. There wasn't really any disagreement on fundamentals. The disagreements.
Well, that's what I say.
Yeah.
Julian Robertson in that interview said, we knew these stocks were overvalued. Mm-hmm. So he wasn't.
Druckenmiller.
It was just a question of how long will it last. Now that doesn't sound like two believers in efficient markets. They wouldn't be having that discussion. There wouldn't be, it's overvalued, should I get out now? It's overvalued, should I ride it a little longer? That wouldn't be the debate if they both believed that markets were entirely efficient.
But do you think that retail investors on their own are capable of generating those types of movements, or the institutional investors provide like an amplifier, right? Because they, they're doubling down on what the retail investors are doing, which kind of amplifies the sentiment.
So I don't really know the answer as to the how much the retail investor can move the entire market. In the studies that I've done, and the study that my colleagues have been recently working on, looking at Robinhood users, it's clear that the influence of retail investors is more pronounced for smaller stocks. Mm-hmm. So clearly they have their actions can affect smaller stocks much faster. I believe that overall sentiment does affect the market at large, because if you think about what drives the market up or down, fundamentals are one thing. If everyone acknowledges that companies are going to be earning less in the future, probably prices go down. Taxes are something. Why did the people, back when Trump was elected, the stock market went up, and people were saying, well, why is it going up? Shouldn't all the uncertainty around his behavior be causing it to go down? But I think, and other people have said that no, the thing that was pretty certain was that with a Republican president, a Republican Senate, and a Republican House of Representatives, there was a tax cut coming. And a corporate tax cut makes the market worth more, because you can think about a company earns money It pays its employees something. It gives the government something. It pays its bondholders, and the rest is kept by the shareholders. If you pay your employees less, the shareholders earn more. If you pay the government less, the shareholders earn more. Generally, you have to pay what you pay the bondholders is usually not easy to manipulate, but there's sometimes. But so what I'm thinking is that the other thing that drives markets up is when more and more people put their money in the market. So, and one of the things that causes people to put their money in the market is that the market is going up. Not the only, but it has probably be tied to a story or to something. But that's what, and then it tends to snowball a little bit. Like, right, as I say, use of margin. The use of margin was way up in 1999. I believe it's probably high at the moment. The use of margin by individual investors, the willingness to borrow money so as to buy more stock. So, there's a certain amount the stock market is a secondary market. It's generally, people trading stocks that already exist. If you want to buy a stock, you have to offer someone who already owns it enough money they're willing to sell it. If they're the one who wants to sell, they have to sell it to you at a price where you're willing to buy. If there are a lot of people who want to buy and the people who currently own are kind of content, then that starts to drive the price up because the buyers have to bid up the price to get the people who own it to sell.
But I think it's kind of a mischaracterization of both behavioral finance and kind of the world we see to think of the investor community as being divided up into these kind of irrational system one retail investors and these rational system two institutional investors. I think people at all levels are susceptible at some degree to these psychological biases that you've studied so well. And I think there was one time when you and I ran a workshop for some high net worth financial advisors. We ran them through a bubble experiment. I think we got the biggest bubble that had ever been seen in the history of the literature. And I don't know whether anybody else has tried to do that with financial advisors, but it seems like, and a lot of the hedge fund managers that I know, they really kind of work hard to put themselves through some kind of psychological hygiene process on a regular basis to alert themselves to any of the biases that they may be succumbing to. I mean, for modeling purposes, it might make sense to have these two separate actors, but there seems to be more continuity than that across these different communities. Is that a fair assessment?
Well, another way of put it is that professional investors are also human.
Yeah, that's another way of putting it, right?
And they have many of the same biases. I think they have had more learning opportunity. So as you say, hedge fund managers who consciously try to recognize and to deal with their own biases, to be aware of them, to watch out for them. And certainly that helps. When I took behavioral decision theory as an undergraduate from Danny Kahneman, I remember him saying one day that although he and Amos had identified many of these biases and heuristics, that he fell prey to them, or they affected his judgments every single day. So knowing that you have these biases is useful, but it doesn't instantly stop you from being influenced by them. I think institutional investors sometimes come up with checks, balances, protocols. For example, there's something called the disposition effect. I think you said Mayor Statman is going to be one of your guests soon. So Hersh Sheffrin and Mayor Statman, two good friends of mine and longtime behavioral finance researchers, coined a term called the disposition effect. And that was for the tendency of people to hold onto their losers and sell their winning investments, sell things they had done well. And one of the first papers I wrote when I got the data on, in fact, the reason I started trying to get data on individual investors was I had read Statman and Sheffrin's paper on the disposition effect recently, which was mostly a theory paper with a little empirical part, but it was mostly laying out the theory. And I thought, yeah, that's what people do. That's what I did when I had been an investor. And I thought, I did that many times. I held on to my losers and told myself they're coming back. I sold my winners.
Get evenitis.
And yeah, and I was sitting in a class that George Eklof was teaching. George Eklof is famous for many reasons. He won a Nobel Prize in economics. He's also married to Janet Yellen, who is about to become our new Secretary of the Treasury and has been chairman of the Fed. And George this was a macroeconomics class for PhD students. I was auditing. I was sitting in the back of the room, and I don't remember his exact words, but George said, he stopped for a moment. He said, those of you who are planning to do empirical work, don't just take some existing worn out database that people have written dozens of dissertations about and try to squeeze out one more dissertation. He said, find a question that you want to answer and figure out what data would allow you to answer that question. Then go out and get that data and answer the question. So at that point, I stopped listening to the lecture and started thinking about it. What's that?
What a novel concept.
Yeah. So I stopped thinking about the lecture. I started thinking, oh, I just read this paper about the disposition effect. I'm sure that's how people behave. That's how I behaved. Introspecting, I couldn't imagine that many people behave differently. And I thought, well, if I really want to show that, I should probably get data on individual investors because they're the most likely not to have compensated for the psychological biases. So I thought, okay, easy. I'm just going to go call up a brokerage firm and ask them for the trading records for their clients. I'll write my dissertation. It took 11 months. And even then, I got incredibly lucky. I wrote to dozens of firms. I called firms. I came very close twice. And eventually, I was able to get data. It took, they say, about 11 months. I eventually was able to get data on the trading records of individual investors from a discount brokerage firm. And I showed that people do, in fact, ordinary investors do display a pretty robust disposition effect. Many studies since mine have shown it for different groups of traders, even for institutional investors, for people in different markets. But there are institutional investors who recognized this a long time ago. You could read books before Statman and Sheffrin's paper. You could read books that would say, if you buy something and it goes down 10%, just sell it. Cut your losses and move on. And I think that advice was there because it pushed against the psychological tendency to hold on. Even, what you should really be asking yourself, absent transactions costs, a money manager should probably every day be looking at every stock in the portfolio and saying, is this something I would buy today? Mm-hmm. If I didn't own this today, would I want this in the portfolio? And thus, the day that you decide, well, I would never buy it if I didn't own it, you should be thinking about selling it. but the psychology works against that. So I guess there's no short answer here. My long answer is, sure, institutional investors have the same psychology. They have had more time to learn as an institution, and they're more likely to have protocols. They're more likely to do things like you've been asked to sit down, talk to groups of institutional investors about what can I do to control my own biases. There are firms, my friends at Cabot Research have one of their product is basically to help institutional investors, money managers, identify the biases in their own trading. Individuals don't have so much of that. In fact, as we may discuss, if anything, I think many of them find themselves being encouraged to go with the flow, go with their biases.
Yeah. So that advice to every morning, ask yourself, if you didn't own it, would you buy it? I actually tell my students to take that same approach to their jobs and to kind of everything else in their life. It's a little more difficult to accept in some other areas of your life. The transaction costs might be a lot higher. But
the transactions cost to quitting your job because you didn't like yesterday's meeting
right.
could be high. On the other hand, if you've been miserable for the last year, I'd give some serious thought to finding another job. Yeah.
Yeah, but if going back to those days, when you studied with Dan Kahneman, most of the insights that he had and his colleagues had were built around relatively small data sets, really, small experiments really done in the lab or, surveys. And it really wasn't a huge kind of data-centric, large-scale business. I mean, people weren't doing field experiments. They weren't looking at big data sets. So when you did this and you found this, how did the brokerage feel? I mean, to find out that, our customers are really doing poorly. It's kind of like doing a study for a hospital and discovering that all their patients are getting sick in the hospital. I mean, the hospital probably isn't too happy about that. At least in a hospital, they might kind of go in and see if they can get rid of that problem. Do brokerages, how do they respond to this? Do they take an interest in protecting their customers more, or is this something that they wish they could push under the rug, you think?
I think it's a multifaceted response. So I got 2 data sets from a large discount brokerage firm, a firm to which I am truly grateful. It's a very good firm, I think. I then met the CEO at we were together at a conference in New York, and we were talking, and I asked him if I could get a third data set. No one likes to keep the data sort of up to date. And he said to me something pretty close to this. He said, "Professor Odean, we have a lot of respect for your research, but I just don't see what's in it for us." Now, and I have to say, in the short run, he was certainly right. In the short run. Now, one of the reasons I didn't name the firm from which I'd gotten the data in my papers was because I thought, well, people who read that, they're going to say, oh, investors at such and such a firm are overconfident, but I'm at this other firm, so this doesn't apply to me. And I was saying, this is going to apply across the board. As we said, maybe a little more to one group, a little less to another, but it generalizes. And people have subsequently shown that it generalizes using other data sets. So I think there was a concern by brokerage firms that it might make them look bad. Although, if you looked even at the material that brokerage firm had at the time, the advice they gave was buy and hold mutual funds, and even low-cost mutual funds. So they knew what the good advice was, and they gave that advice. And I think a little bit what it was, they're in the awkward position of our most active investors are making us a lot of money. And we don't want to publicly say, oh, everybody should be trading really actively. Although I think maybe some firms come pretty close to that these days. But I don't think that, the firm I got data from wasn't promoting active trading. On the other hand, they couldn't help but notice it was making them a lot of money. So perhaps they didn't want to overly actively discourage it. I don't think anything, I'd like to think that the research I've done and my colleagues and I have done has had some influence, but I don't think we've had a lot on individual investors. I had a reporter ask me in the late 90s or maybe it was 2000 or so, Brad Barber and I had published a paper called Trading is Hazardous to Your Wealth. And this reporter said, well, do you think anybody's going to continue to trade actively after they see this paper? And my response was, I don't think a lot of individual investors subscribe to the Journal of Finance. If there's been any effect, it's slow and it trickles down. And,
Well, I'm sure if you did a study on the data provided by, say, Caesar's Palace, you might discover that on average, the folks who walk in the doors are going to kind of walk out poorer. Obviously, it's not a perfect analogy, but in Las Vegas, at least, they have regulations which mandate the odds within each of the hotels and casinos, saying, you can only lose 1% on average per bet, and then they'll compare across the different casinos. Can you imagine something comparable which could maybe provide some investor protection? I mean, I'm thinking in particular of Robinhood right now, just because it's really gamified investing in a new way, and it's created an addictive. It's an addictive casino-like experience, and it's brilliant. I mean, it's brilliant in terms of maximizing engagement, but it's not clear that their interests are necessarily aligned with their clients.
No, it's not clear.
Yeah, it's kind of like a dating app, right? A dating app never wants you to get married because then your engagement goes down. So now obviously they don't want you to lose all your money because then you can't trade. But it is sort of a new form of interface for which humans haven't really quite adapted. And discount brokerage was similar in the 90s, right? Where you mentioned in one of your articles that I think you quantified the cost of trading in 1960s. I remember when my dad had a full service broker, and he'd call her up during business hours and chat for about an hour to execute some odd lot trade, and it was extremely expensive, cumbersome, difficult. You really had to think hard before you made any kind of trade. Now it's pretty easy. You can do it. I probably could have traded a couple hundred times while I was talking to you, and you wouldn't even noticed.
Yeah, absolutely. I actually have a Robinhood app, mostly because I thought if I'm going to write about it, I should know something about it. So I opened up an account.
Do you suppose the people who study crack cocaine have a similar duty to try out the product that they study?
I don't no comment on that. That was what to do. Part of it, let's go back to efficient markets. So it's sort of a strange thing, because you think of science, as most of us, at least, who've been brought up with a lot of respect for science and research, that it should be a researcher should be interested in figuring out what's true, and thus it should be largely apolitical. And yet, so many things end up political. As we saw in the last year, the science around whether putting a mask on, having everyone wears a mask, drops down the transmission rate of the virus, which is irrefutable, became a big political issue. climate change can turn out to be a political issue. And oddly enough, even, to me, oddly, there's a tension in finance. We're not talking about, labor economics here or tax theory, just basic finance. There is this tension between the efficient markets belief and on one side and, to a large extent, behavioral finance on another, about consumer protection, investor protection. As you mentioned earlier in our talk, if markets are completely efficient, you can't really hurt yourself. You could get unlucky, but you can't systematically make bad investment choices. You might not follow portfolio theory. You might you might fail to diversify. That would be a mistake that you could make. But basically, you're not going to buy something that has been artificially driven way up in price and then be the sucker that ends up, holding it when it crashes down. Furthermore, and that's on the efficient side, and furthermore, if you take the view that people are pretty rational when it comes to money, and this was the dominant view in academic finance, I think, in the 70s and the 80s, with a little bit of, maybe not everyone. There are these people who probably are random in their trading, a little bit random, but basically people are pretty good, pretty rational, and certainly when it comes to money. If you take that view, the combination that markets are efficient and people are pretty smart, especially when it comes to their own money, you say, well, then leave people alone. Why get in their way? Why constrain them? You don't know what they want. They can want whatever they want. It's not for the government to get involved or regulators to get involved. If you think that people make systematic biases, that markets can become inefficient, especially both as a whole, but cross-sectionally, like some stocks the price get driven up and then drop, that there is that who buys at the wrong time is somewhat systematic, that the same group of less experienced, perhaps more naive investors tend to be the ones who suffer, then there's more of an argument for having policies that protect people. I gave a talk in Beijing several years ago at the China's equivalent of the SEC, and after my talk, I was talking to their head of research, and he asked me if I thought that investors, this idea that investors should have there should be some sort of equivalent to a driver's license to invest. And I just said, I just can't see that happening in the U.S. Whether it would be a good idea for people who are investing to understand markets and investing more. Yeah, of course.
We do have the qualified investor criteria, but it seems to be that the first of all, it's not a competence requirement, and then secondly, it seems like the things that fall into the qualified investor bucket and the non-qualified investor bucket are not a function of risk, really. There's plenty of things that only qualified investors can get into that are fairly safe, fixed income, private equity type stuff. And then there's a lot of things that, unqualified investors can get into that are, crazy, like, shorting GameStop or something like this, right?
Yeah, sure. I think that, as you say, on the qualified thing, it is to some extent just a measure of, do you have enough money that we don't feel we have to worry about you?
We don't feel bad for you if you lose it all, right?
Yeah, or that you won't lose it all. Of course you could, but so anyway, the guy I was talking to in Beijing, I said something like, well, maybe you guys could do that, but I just can't see the U.S. accepting this sort of constraint, like you have to pass a test to be an investor. And I'm not really sure. I mean, it'd be great to have some basic education, I'm not sure it would do a phenomenal amount of good. His response was, he said, I think it'd be even harder to do that here. And even though you think, well, the Chinese government can pretty much do what it wants, he just thought that the amount of enthusiasm that people had at the time getting into the markets, and the Chinese markets have had some big ups and downs. He said if you started to keep people out, there'd be a lot of anger.
Well, one interesting thing that you wrote about was how, in many ways, the stock market's not a substitute for other investments like real estate. It's really a substitute for things like the lottery. And so when a country introduces a lottery, the kind of turnover in the stock market goes down.
Yeah. So, okay. The stock market, I think, is a closer substitute to investing in the stock market long term. Is to me more analogous to investing in real estate long term. Mm-hmm. Trading every day in the stock market, unless you are truly a professional, let's set them aside. But for individuals trading every day, that to me is closer to the lottery. And you're right. In the study that I mentioned before of where we looked at all Taiwanese investors, we had a little, almost an aside in that paper, where we took a look at when Taiwan instituted a national lottery. And that's not to say that you couldn't gamble in Taiwan before the national lottery. There were obviously ways to gamble, but they instituted a national lottery, and we had a little model of expected trading on the Taiwanese stock exchange. And trading fell 25%. When the lottery came in. And what we thought was going on is a lot of these people are trading, and turnover was very high. The individual investor turnover would be 300%, 400%, 500%. That means that every stock gets bought, say if it's 500%, every stock gets bought and sold. Every share of every stock on average gets bought and sold 5 times a year. So there were clearly a lot of speculation going on. And we thought, well, a bunch of people just said, this week, this month, I'm going to try the lottery instead of gambling on the stock market. So, yes.
So the losses now, instead of going to the institutional investors, go to the government, right? And so.
Yes. Although the government in Taiwan was making a little money because they had a transactions tax, a stamp tax, which I think Larry Summers briefly proposed in the U.S. once and got so much flack for it, never got mentioned again.
Well, you know what this stock exchange that Eric Ries has proposed, I think, has some kind of incentive scheme to try and get people to hold on to their stock longer. But I wouldn't want to let you go before asking you about your background and experience, because you have kind of an unusual trajectory into academic finance. Most people don't kind of spend some time as a monk and a taxi cab driver and a hitchhiker across Afghanistan. How is and this show's called Unsiloed because I'm always very fascinated by people who have taken a circuitous intellectual journey, and I'm wondering if you see any connections between that intellectual journey early in your life and the kind of unique insights that you're able to find in your chosen discipline, which are in many ways crossing boundaries, leaning on other disciplines, and sometimes questioning the status quo in your discipline.
All right. Well, let me correct one thing. I was in the Benedictine seminary. I dropped out before I became a monk. Okay. So it was my intention to become a monk, but I didn't make the grade.
That's very fine distinction. I think in today's world, if you watch a monk video on Calm, you can call yourself a monk. So I think you're being a little too strict.
Yeah. Okay. I did drive a taxi in New York, 1970. I did hitchhike in Afghanistan. 1971, I think I was hitchhiking. And
you started your own company, didn't you?
Twice. Pardon?
You were an entrepreneur as well, were you not, in software?
I wouldn't say very yes, a software, a statistical analysis software. Yeah. Um, yep. And although it was my friend's company, but let's see. Yeah, I dropped out of college, went back when I was 37, and wanted to get a PhD in psychology. And I ended up, I came back and, I was told that it was because I had dropped out of my senior year. I dropped out of Carleton College 5 months before graduation, which upset my father to no end.
Were you psychology major there too? What was your major?
No, at Carleton, I actually never ever formally declared a major. I was trying to major in creative writing. And then I ended up dropping out. I had taken a lot of psychology classes, but I didn't have I wasn't a psychology major. So I went back to Cal, and admissions person I talked to told me that if I said I wanted to major in psychology, I was less likely to get admitted because there are so many psych majors. And I said, well, what about statistics? Because I'd been working in a statistical analysis software company, and I'd liked math, and I liked statistics. I actually had a job as an actuarial trainee for 3 days in New York before I quit it and decided to drive a cab instead. So I got admitted to Cal. I majored in statistics, but I knew I wanted to get my PhD in psychology. And I figured, a major in statistics with a lot of psych courses was not going to hurt me at all when I applied to a PhD program in psychology. I started taking psychology classes in addition to the stat classes, and that's when I met Danny Kahneman. I actually knew who Kahneman was. I'd been at my friend's house where my friend who had the software company in Minneapolis, and one day, and my wife Martha was there, and David and I were talking, and after we'd been talking, she handed me a magazine, Discovery magazine, and said, you should read this article. And it was an article about Kahneman and Tversky and about the research. And I was like really excited. I ordered their book from Cody's bookstore here in Berkeley. It took 6 weeks to get this book called Judgment Under Uncertainty. They were, sort of an anthology, or they'd edited a bunch of papers, and I got their book. But Kahneman, when the book was published, had been at the University of British Columbia, so I didn't know he was at Berkeley. And after one semester at Berkeley, I decided I'm going to take some psych classes. I looked in the course catalog. I saw the name Kahneman, and it's not a very common name. And I thought, is that the Kahneman? I actually got on my bike. I saw he was teaching that afternoon, rode over to where he was teaching. I think it was in Dwinelle, I'm not sure. And walked in the back of the room and said, yeah, that's the guy. So I signed up for his course on judgment decision making, and got to know him quite well. And I was still thinking of getting a PhD in psychology, and I talked to him about it. He said, come over Saturday morning. He lived, at the time he owned a house about 4 blocks from where I live. And I went over to talk to him, and he basically convinced me I should go into finance. He gave a bunch of reasons, including, he said, look, behavioral finance hasn't taken off. And if you're lucky, you'll get to be one of the first people working, not the first, but one of the early people working in a field. And he said, and if you're not lucky and it doesn't take out and doesn't work out, you'll have a PhD in finance. You'll go get a job in industry on Wall Street, and you'll have more money than if you had been an academic. So there was a decent fallback plan.
Yeah, versatile. Last question. When you were a cab driver, was your supply curve upward sloping?
What did I do if it rained?
Yeah.
All right. When it rains, I don't have a clear answer to that.
You don't have any data?
I didn't keep. I was doing it for the money, but also for experience. I was driving out of a garage at the time. These cab companies owned the medallions and they had the cabs. I know it changed later and people started to own their own medallions and their own cabs. But at the time, these cab companies owned a bunch of cabs. And people like me, I'd met a friend who worked at a cab company. He got me a job at his company. I'd show up around 4 o'clock. They'd give me the oldest, most beat up cab in the garage because I was the newest driver. And this was about 170th and just near Jerome Avenue in the Bronx. And I would drive down to Manhattan every day because I wanted to see the big city. I would just drive. You had to be out for, they wanted you to be out for between 9 and 12 hours. If you stayed out over 12 hours, you're breaking a law. And if you didn't stay out 9 hours, they thought, you weren't worth their time. So I would drive to about 1. So I was actually more concerned about, I wouldn't have, if it was raining, I didn't hit something and go back. I just hit time. I went home. I'd go back to the cab company, and then I had to hitchhike. I was living in New Rochelle, and I would actually get out on the Cross Bronx Expressway at 1 or 2 in the morning and hitchhike back up to New Rochelle. It was a little bit of a crazy summer.
Maybe you can be an Uber driver and do some firsthand sentiment research.
Interesting thing. One thing about Uber, like many, I think that they're exploiting their drivers when they say, oh, these are all independent contractors. They shouldn't get benefits. They shouldn't be able to collectively bargain. That side of it, I don't like at all. But the technological side has not only made getting a cab or an Uber much more convenient for the users, it's also made driving much, much safer. Mm-hmm. So I drove a yellow cab. I got paid cash. I got held up at gunpoint. And it was the typical thing. The people who were robbing, the rounds you'd start robbing people around 10:30, 11 at night, and then then early in the morning they'd stop because you wanted to get the drivers who were coming to the end of the there was a shift. There was the day shift, and then the evening shift would start, around 4 and end around midnight or so. So I'm driving cab. Driving a cab. I'm legally obligated to pick anybody up. The other cab drivers told me who they thought I shouldn't be picking up, but I picked everyone up. I've got cash. I have to go wherever someone tells me to go, and I don't have a radio. I picked up a couple of guys. They took me uptown, and to a somewhat deserted street. They said, "Oh, just a moment. We gotta grab something." The guy actually got out, walked over to a little doorway, came back with a paper bag, and pulled a gun out of it, and put it to my head. So I gave him my $25. Yeah. It wouldn't happen with Uber or Lyft or any of these. First of all, you're not carrying cash. To a large extent, they know who the customer is. Mm-hmm. Sure, somebody might get a fake credit card to take an Uber ride, where you don't know who the real person is, but they're not going to do that to rob you of, $100 or something. It's much safer.
I remember when I was in Argentina, they would tell me, "Oh, don't take Uber. You don't know who the driver is. You got to take this remise, which is run by someone that we've known, who knows somebody, who knows somebody, who knows somebody." And I thought, well, I think Uber sounds a lot safer. You're a little overconfident in your network. Well, this has been great, Terry. Thanks for coming. Thanks for talking. I should mention to everybody that Terry has a fantastic set of YouTube videos on personal finance. We didn't even talk about that, and I think that's been occupying a lot of your time at Berkeley. He teaches the personal finance course to hundreds of students, and I think that has probably made a big impact on their lives. Even if they don't read the Journal of Finance, they can certainly watch your YouTube videos and take some important lessons from that. So thanks so much, Terry. Appreciate it.
Thanks, Greg. Bye-bye.
This is Unsiloed, brought to you by Alumni FM, connecting people through stories.